Thank you all for coming. We're excited to welcome two engaging speakers for our upcoming Bitcoin talks. Matt Gallagher is a financial advisor from Vista Investment Partners, where he co-founded Orange Horizon Wealth, a division dedicated to Bitcoin-focused wealth management. Since joining Vista in 2020, Matt has immersed himself in studying Bitcoin, now considers it the most important financial innovation of his lifetime. He works with clients to integrate Bitcoin into traditional financial planning and actively educates investors and advisors through seminars, articles, and podcasts. Matt holds multiple securities licenses and brings over a decade of experience in insurance, investments, and wealth management. He earned his bachelor's degree from Indiana University, Bloomington, and lives in Richmond with his wife, Deborah. Our second speaker, right there, is Jonathan Camps. He's a CPA with a deep interest in markets and value investing. Initially skeptical of Bitcoin, he became a passionate advocate in 2020 and now supports Orange Horizon's wealth operations. With a background as a controller in the used car industry for 11 years, Jonathan brings strong financial expertise and a commitment to education. He holds a degree in accounting from Grace College and enjoys learning about Bitcoin, traveling, and cooking. He lives with his wife, Angela, and their two children, and is an active member of Christ Presbyterian Church. The first talk today is going to be with the problem with fiat money. Before Matt, who's already here, but before I give him the mic, please make sure your phone is on silence. And just a small personal note, when I first heard of Bitcoin, it was $2. Okay. I think I heard it long before I even read about all this stuff. Just a little history. That's how far back I go with Bitcoin, I guess. I want to also thank the School of Business and Economics for sponsoring this talk, the Institute for Humane Studies, and the Center for Entrepreneurship and Economic Education. Please join me in welcoming Matt.
Thank you. It's great to be here with you today. I actually took some of my classes here at IU East, majority in Bloomington, but it's wonderful to be with you here today.
Where you up to?
The topic at hand here is Bitcoin, but I usually, when I'm asked to explain it, I usually like to start by explaining what the problem is with normal money. So the title here is the problem with fiat money. And can I get a show of hands? How meaningful is the term fiat money? You heard that term before?
Yeah, I don't have all the.
For those who haven't, it refers to money that is not backed or linked to a real world asset or commodity, like gold or silver. And that is the form of money that we've had in the United States for the last 54 years. So an alternative title of this slide could have been the problem with the current monetary system. But to give you an overview of what we're going to talk about here today,
Oh, okay, so I got time.
Bitcoin is often discussed in the context of investments.
So
when I'm we're going to start by exploring some foundational investment topics, and then we're going to move on to the characteristics of money, and then we're going to get into a brief history of monetary technology and explore the transition from gold and gold-backed currency to our current age of fiat money.
Good enough for me.
And then we get to the main topic of today's talk, which is what's the problem with normal money? What is the reason for Bitcoin's existence? What's the problem it was trying to solve? And then briefly, we'll talk more about this tomorrow. We'll talk about how Bitcoin has the potential to be the solution to that problem. So investing money, investments or investing is one of those words that everyone has heard of, everyone has used, but is somewhat difficult to come up with a foundational, rock-solid definition. At least it was for me when I attempted to do that a few years ago during my initial exploration of Bitcoin. And that led me into the etymology of the word, or the origin, which is derived from the Latin root vestis, which refers to clothing. And from that comes the metaphorical meaning for symbolic clothing. And that's where we can hear echoes of that still today in the English language by the powers vested in me. Think of a pope's hat, a judge's robe, a sheriff's badge. So in that context, to invest under that meaning would mean to endow with symbolic power or authority through the bestowment of symbolic clothing. And the financial word investment is somewhat related. In my mind, how I think about that is to invest money is to empower either yourself or somebody else with the enhanced capacity to perform productive economic work through the bestowment of money. So use a simplistic example. Let's say that I have money and my friend has fertile farm ground. It's undeveloped. He doesn't have any money. He doesn't have any equipment. He doesn't have any way to cultivate the ground, but he believes that he could have a profitable farming operation. So we come to an arrangement where I choose to invest in him. You can broadly think of investments as falling into one of two categories. The first would be a loan or a debt or a credit investment. So under this example, let's say I give him a $1 million loan due in 5 years, and along the way, he has to pay me 5% interest. So I give him $1 million, he uses that to buy equipment, seed, fertilizer, all the things that he needs to develop his farm. He has to pay me $50,000 a year for 5 years, and on the last year, after 5 years, he has to give me my original $1 million back. The other type of investment is an equity investment, and in that case, I'm not loaning my friend the money. I am purchasing ownership, partial ownership over his farm operation. So in this example, I give him $1 million, and in exchange for that, I become 20% part owner of the farming operation. Going back to this one here, this simplistic example can allow us to examine the fundamental trade-offs between credit and equity investments. And when you hear credit or debt, that's typically what you're purchasing when you buy a bond. That is a credit instrument. But the nature of that is that it has capped upside, meaning it doesn't matter how successful my friend's farming operation is. Even if he makes millions and millions of dollars, the best case scenario that I can hope for is to get repaid all of my principal and interest back on time. In other words, the best case scenario is after 5 years, I end up with $1.25 million. In exchange for that cap upside, however, I also have certain protections that do not exist in an equity investment. For example, if my friend fails to pay back principal and interest on time, I have a creditor relationship with him. I have recourse to, in this case, seize the farm ground. These investments are typically collateralized by the underlying property that the investment is meant to develop. So broadly speaking, when you think of stocks and bonds, equity and credit, credit has less growth potential, but it's also considered by and large less risky. There are, of course, exceptions to that. Conversely, with an equity investment, I'm not guaranteed anything. I'm not entitled to anything unless the farm produces. So, obviously, in the case of gross negligence or fraud, if my friend takes my $1 million and then goes to Vegas for a month and blows it, there I could take him to court. I would have some sort of recourse. But if he simply honestly fails, if he's not a very good farmer and he never turns a profit, I'm never going to get any return on my investment. However, if he's wildly successful, if he becomes the Jeff Bezos or the Elon Musk of farming, I own 20% of that operation and I'm entitled to 20% of the profits forever. So with equity or stocks in general, we'll explore this a little bit more risk, but more potential reward. So when I was at IU, my corporate finance professor taught us that the value of any investment is the net present value of all future cash flows. And he taught us what I found to be a very useful analogy for thinking about an investment like a stock or a bond, which is to think of it as a cash printing machine that you can take, put in your house, and periodically it will spit out some cash. So how do you figure out what that's worth? The most common methodology in the investing industry over decades has been some version of a discounted cash flow method. And what that entails is, number one, you project out what you expect the cash flows to be. In other words, how much cash is this machine going to spit out, and when's it going to spit out that cash? The second step is you apply the discount rate. The reason you apply a discount rate is because of the time value of money. For example, if I were to offer you to buy a cash printing machine that is going to print out $1,000 1 year from now and then stop, and ask you what you'd be willing to pay for that, the answer may vary in this room, but probably the answer is or should be less than $1,000, because $1,000 today is worth more than $1,000 1 year from now. And that's true for a few reasons. One of those is simply risk. If you have $1,000 now, there is no risk that you're not going to have $1,000 because you do have $1,000. An expectation of $1,000, you have to assign a probability that that $1,000 will actually be produced. And for different investments, there's different probabilities, different risks, but the future is uncertain. And so for that reason, future cash flows are discounted the farther away they are in the future. The second reason is opportunity cost. Instead of buying this cash printing machine, I could buy another cash printing machine. I could make another investment, or I could spend the money, or I could do nothing and just save the money for a rainy day. So investments are valued in relationship to all other available uses for the money, whether that's investing it or saving it or spending it. For example, let's say that the cash printing machine was going to spit out $2,000 a year from now. Would I be willing to pay $1,000 for it? In general, yes. That's doubling your money in 1 year, 100% return. That would typically be considered a phenomenal investment. But what if that's the only $1,000 I have to my name and my rent's due tomorrow? In that case, the opportunity cost of not paying my rent is higher than, admittedly, a very good investment. So the third reason you apply a discount rate is inflation. And we'll talk more about this later, but it's simply that if I expect the price of everything to go up 5% a year from now, then I would demand at least a 5% return on my money. Otherwise, I'm less wealthy a year from now, even though I may have more dollars. So those are the three main components that go into that. But the process is you project out or estimate all the future cash flows that you expect an investment to produce. You apply a discount rate to them, add them all up, and in theory, that is the value of the investment. And an important concept in our industry is diversification, where, back to the cash printing machine analogy, most investors don't want to spend all their money on one single machine, because no matter how good it is, no matter how well it's constructed, it can break. Something can go wrong. So it's the age-old adage of don't put all your eggs in one basket. And so a diversified portfolio typically is made up of a variety of different stocks or equity investments, a variety of different bonds or debt or credit instruments, or it could include mutual funds and ETFs or exchange traded funds, which typically are baskets of stocks and or bonds. It could also include alternative investments. And here's a chart that explores the trade-off between risk and reward that I mentioned, where as a proxy for bonds, the green line here is the core US aggregate bond index. The blue line, as a proxy for stocks, is the S&P 500 index. And this shows what would have happened if an investor put $1 million into each one in the year 1995, at the beginning of that year. You can see the green line, the bond investor, had a much smoother ride. There were a lot less ups and downs along the way, but they ended up with a lot less money than the person who was willing to tolerate that volatility by investing in the stock market. And so this trade-off has led to what has been I would say the benchmark for a diversified portfolio for the last 50 years, which is some version of a 60-40, 60% stocks, 40% bonds. And in our industry, that's typically known as a balanced portfolio. So looking at stocks here, this shows the return or the growth of $1,000 for an investment in the S&P 500 for the last 10 full calendar years, so the beginning of 2015. And you can see $1,000 after 10 years grew to $3,425. And that comes out to an average annualized rate of return of 13.1%, which is pretty good. But over the last 15 years, and especially over the last decade, a new asset class has emerged. And you can think of it on that spectrum between risk and return. The way that that new asset class has behaved is the same in relation that stocks are to bonds, meaning higher risk, higher reward. That new asset class is called Bitcoin. Someone who bought $1,000 worth of Bitcoin at the beginning of 2015, after 10 years, their investment would be worth $432,659, which gives us an average annualized rate of return of 83.5%. So with the track record that it has, well over a decade of price performance, I'll show here, this is a more granular view of Bitcoin's US dollar exchange rate over the last 10 years, from October 1st, 2015 to October 1st, 2025. And I'm not going to call out all these individual prices, but I'll just point out, for example, in March of 2020, Bitcoin was around $5,000. April of 2021, it had risen to 63,000 and then fell a few months later to 29,000. And then went back up later that year to 67,000. And then a year later had fallen all the way down to 15,000. And today it's somewhere around 115,000 last I checked, peaking a few weeks ago at 125,000. So obviously for money that you're planning on spending a day from now, a week from now, or even a month from now, you may not want to hold it in something as volatile as Bitcoin. But something that turns $1 into $432, you would think would be at least interesting to my industry, to the extent that our job is to accrete wealth over the long term for clients. But to this day, as of right now, 2025, I would say the majority of our industry, the investment profession, is still somewhat dismissing Bitcoin or ignoring it. So why is that? Something that's outperformed gold, outperformed stocks, outperformed bonds, outperformed real estate, outperformed every other major asset class. Why is it that still most money managers have not embraced Bitcoin like our firm has? I would say I could have put more things up on here, but three main reasons. These are the three main objections that I hear from our colleagues in the industry around why, despite its superior performance over the last decade, 15 years, they still don't believe that Bitcoin is a good investment. The first reason is that Bitcoin doesn't produce any cash flows. Now remember, if the value of any investment is the net present value of all its future cash flows, then an investment that has a projected cash flow of zero forever is worth zero. And so by that logic, they say that Bitcoin doesn't have any fundamental value as an investment because it doesn't have any cash flows, which is why investments like stocks and bonds are valuable in the first place. The second reason given typically is Bitcoin isn't backed by anything. That can mean a few different things. For example, it could mean that it's not collateralized by anything. Remember, a bond is not only valuable because of its cash flows, but debt investments can also be valuable because they're collateralized by underlying property that can be taken ownership over if the payments stop. But more often, what they mean by that is that it's not an asset-backed currency, like a gold-backed dollar, like the US dollar used to be. And then the third reason, because of those two, they will observe the fact that people only buy Bitcoin because they believe they'll be able to sell it to someone else in the future. And taking all of these together, that sounds like the greater fool theory, which is a common phenomenon in bubbles, financial bubbles. The greater fool theory is, yeah, this thing's not worth anything, but I'm going to buy it because someone even stupider than me is going to come along and pay me even more for it. And the reason they're going to do that is because someone even stupider than both of us is going to buy it off them for even more money. Well, eventually all bubbles pop, and eventually you run out of idiots with money who want to buy this thing, and the person left holding it loses most or all of their money. So we still hear pretty commonly that Bitcoin's a bubble, Bitcoin's tulip bulbs, which refers to a famous bubble that occurred hundreds of years ago, or even Bitcoin's a Ponzi scheme. We still hear that somewhat regularly. So, since I and my firm have embraced Bitcoin as an asset class, you might expect me to refute these three objections, but I'm not going to, because they're all true. Bitcoin's fundamental value as an investment in the strictest sense of the word is zero, because Bitcoin's not an investment. Bitcoin is money. It is a monetary good. So Bitcoin doesn't produce any cash flows. Correct. Bitcoin is not a credit or equity investment designed to produce money cash flows. Bitcoin is the money. Bitcoin isn't backed by anything. Correct. Bitcoin is not a money-backed currency. Bitcoin is the money that would back a currency. People only buy Bitcoin because they believe they'll be able to sell it to someone else in the future. Correct, because that is the entire point of money. Money is an intermediate good. It is valued not for its own sake, not for its consumption value. It is valued for its salability, its ability to be sold to or exchanged with someone else in the future. That is the point of monetary technology, and Bitcoin is money. So, with that, we're going to transition away from investment fundamentals and explore that topic in a little bit more detail. What is money? The way I define it is that money is the technology that humans use to preserve, trade, and measure economic value. Another way of saying that is something that you'll commonly see in an economics textbook, that the three core functions of money are as a store of value, a medium of exchange, and a unit of account. Right? Show of hands, are those familiar with everybody, those terms? Okay. So I want to make the point here that there's a common idea that money is a shared delusion in society, that money only has value because we all believe that it has value. And in a sense, that is true, in the same way that I could say that automobiles only have value because we all believe that they have value as transportation technology. Because if we all agreed that donkeys were a better form of transportation, then we would all in fact use donkeys instead of cars. But of course, that's not the reason why the automobile became a dominant transportation technology. It simply is the case that some forms of transportation technology are better than others. And that's no less true with money. Money is a technology. Certain monetary technologies are better than others. And there's a handful of characteristics that define whether an economic good makes for good money or not. Those are typically listed as something that is durable, portable, divisible, fungible, verifiable, and scarce. And you can see the AI image that I generated a few weeks ago is bananas sitting in a bank vault. So another example I use is that if you imagine someone has $1 million and they decide bananas are the best form of money, so they convert their $100 or $1 million into 1 million bananas, we don't have to have a debate about what's going to happen. It's pretty predictable that soon that person won't have any money left because bananas do not, in fact, make good money. They are a bad monetary technology. And that leads to an interesting question where, for thousands of years, gold functioned as the preeminent monetary good. It emerged in economies all around the world as the dominant monetary technology. But why gold? Why not something else? Gold is durable, portable, divisible, fungible, verifiable, and scarce, but so are a lot of other commodities, so are a lot of other metals. And the fundamental reason, this is explored in the first Bitcoin book I ever read was called The Bitcoin Standard by Austrian economist Seyfried Namus. And the way he described it, the fundamental reason why gold monetized organically across the world in the free market is because it is the commodity that humanity could find that was hardest to inflate the supply of. And that refers to a concept called stock to flow ratio. So what this shows is, one way to think about it is gold has about a 1.5% inflation rate. The above ground gold supply grows by about 1.5% per year, which means that the above ground gold supply is approximately 66 times bigger than the amount of gold humanity is going to mine over the next year. Compared, however, to silver, has an inflation rate, the supply of silver expands by about 5% per year, or the the amount of silver in the above ground supply is far less than the amount that we mine every year. And then it's probably hard to see those bars, but this looks at oil, copper, corn, and wheat. And the stock to flow ratio of a lot of commodities is simply close to 1, which means there's about as much of it lying around as we produce every year. The reason why that's important is because if any society begins treating any economic good as money, if they monetize it, that creates an enormous incentive to produce more of it. The stock to flow ratio is what allows the commodity to resist inflation in the face of monetization. So, in other words, if we all decided that corn was money, guess what farmers are going to produce a lot more of beginning immediately. So you see that monetization creates the incentive to massively increase the supply. When you increase the supply, the price crashes down. It's not a suitable store of value type of asset. And there have been other commodities throughout history that have partially somewhat functioned as money for a time. Salt, I think, is a good example. But there's a pretty good reason why salt never caught on as a dominant monetary good, because you can predict that some enterprising person who lives next to a body of salt water is going to pretty quickly figure out that they can produce an enormous amount of salt, take it to that community that's using the salt as money, and then take all their stuff through trade by hyperinflating their currency. So this is the foundational quality that determines what economic good will monetize in a decentralized fashion in a free market economy. Going back to the characteristics of money, gold's pretty durable, pretty portable, divisible, fungible, verifiable, scarce, but it has some critical limitations. It's divisible, but really not divisible enough to function as a medium of exchange for everyday purchases. The price of an ounce of gold right now is around 4,000, 4,100, something like that. Imagine going to your local convenience store and buying a soft drink worth $1.79 with gold. That would be pretty difficult. And as a result, throughout gold's history, you will see the monetization of lesser metals alongside of it to accommodate lower value transactions, such as silver, bronze, etc. So divisible, but not divisible enough. The other quality it has verifiability. You can verify gold, it's an element, but if you've ever seen like a Western or an old pirate movie where someone paints a gold coin down on the counter, they take it and they bite it, that's because gold's a soft metal, and that was a way to try to verify how much gold was actually in the coin. But in reality, the only way to know for sure is to perform expensive and burdensome chemical tests to assay the metal. And what you see in the image there, in the middle one, is a gold bar with a center of tungsten. And false gold, usually via tungsten, is still a major problem in the modern gold market. So it is verifiable, but it's very costly and unwieldy to do so. But probably the biggest one is gold's portability, or in the modern age, I would use the word transmissibility. Forget paying $1.79 for something locally. Imagine you wanted to buy something for $1.79 from someone across the ocean. And as telecommunication technologies like the telegraph and the telephone, the fax machine, enabled humanity to begin sending payment information around the world at the speed of light, you saw a massive divergence between the speed of payment and the speed of settlement. The result of this is that rather than transacting directly in gold, gold owners would deposit their gold with a trusted institution, namely a bank, and that bank would issue redeemable certificates for gold. And then the certificates would be traded around, and not just paper certificates, but also increasingly digital ones, the modern checking account. And that put the modern monetary system, or the old monetary system before the gold standard went away, in a position where it scaled as an interbank credit network, where economic participants exchanged IOUs for gold with one another, whether they were paper or digital. And the cumbersome final settlement of gold only had to occur between banks periodically. The problem with this, though, like I said, when you monetize anything in an economy, you create an enormous, irresistible incentive to inflate the supply of that thing, to produce more of it. In this case, we monetized gold-backed credit claims. And whereas with gold, gold is unforgeably costly to produce. Anyone in here, if they want, can attempt to expand the gold supply. But there is no way to do that without expending time and energy. No one can print gold. That's not true for gold-backed credit claims, which can be produced costlessly. So the predictable result of this is that banks produced more IOUs for gold than they had gold in reserve, and every central bank in the world defaulted on its obligation to redeem gold-backed currency for gold. And that culminated in 1971 when Richard Nixon closed the gold window, and we have lived in an era of fiat currency ever since. Money that is only valuable by fiat or by decree via legal tender laws, that's backed by nothing and that has no link to base reality. The pseudonymous inventor of Satoshi Nakamoto described the problem, the fundamental problem he was trying to solve, like this. The root problem with conventional currency is all the trust that's required to make it work. The central bank must be trusted not to debase the currency, but the history of fiat currencies is full of breaches of that trust. And this creates an enormous amount of downstream negative effects in society. The first one I'll identify is malinvestment. That simply refers to the inefficient or incorrect allocation of capital, leading to wasted resources and economic inefficiencies. So why does that take place? Recall that when I'm trying to determine whether an investment is worth making, part of what I have to consider is my opportunity cost. What else can I do with the money instead of buying this particular investment? I could buy another investment, or I could just spend it on something. But the important one here is I could do nothing with it. I could save it. But now imagine that the money is going to be half as valuable a year from now, or 1/10 as valuable a year from now. This induces an artificial demand to deploy money at risk in economic ventures that would otherwise not get funded, because the opportunity cost of saving is destroyed. When money no longer functions as a long-term store of value, that stimulates an artificial demand for investments. And of course, not all investments are a good idea. So there's an old saying in the Bitcoin space that when your money is a melting ice cube, any crappy refrigerator is better than nothing. Another problem that that we see is the monetization of non-money goods. The most prevalent example in the economy of this today is real estate. And what this means is that when the money ceases to function properly as a store of value, economic participants will monetize non-money goods, goods that should be utility or consumption goods. And I've told a joke in a Bitcoin seminars before where I'll ask everyone to think of the price they paid for their house. And then I'll ask them to think of the price they would have paid for their house if they knew they could never sell it. As you can imagine, the second answer is a lot lower than the first one. That number, whatever it is, the amount you would have paid for your house if you knew you could never sell it, that is its utility value, its value as a dwelling. Everything above that is a monetary premium. And the joke that I tell is, of course, you may be aware that housing affordability is relatively low compared to the past. And we all want houses to become more affordable for young people, but no one wants their house to become more affordable for young people. Because as it turns out, investors who are using real estate as a savings vehicle are competing with people who want to purchase them in order to live in them. Another negative effect is called the Cantillon effect. And the easiest way to think about that is that the closer you are to the money printer, the more you benefit at the expense of everybody else. So imagine that I decided to start counterfeiting currency. And every morning I'd wake up and I'd go in my garage and I would create $10 million of fake $100 bills. Now let's imagine that I'm a pristine counterfeiter. These forgeries are perfect, meaning that the places I spend them at don't have any problem. They can deposit them in their bank account, they can spend them with somebody else, and they never have any issues. So I might be tempted to think that I'm committing a victimless crime, but of course I'm not. I am harming my local community. If I create $10 million of fake money every morning and go out in this community and spend it, and buy cars and properties and houses and go to restaurants and start spending that, I am actually harming the community. It's just not as obvious as it would be if I ran around robbing people at gunpoint. The harm primarily comes from the Cantillon effect, where who benefits the most in that example from the inflation of the local money supply? Well, I benefit the most. I'm the one who gets to spend it first. Who benefits the second most? The businesses that I spend it with. They make a lot of money too. They get a lot of business that they otherwise wouldn't have gotten if I hadn't done that. But you move further and further down, and pretty much everyone else is just going to start noticing that the price of everything here in Richmond keeps going up for some reason. So the concept there, when you think of counterfeiting is illegal inflation. Inflation is legal counterfeiting. And what I mean by that is this dynamic, this societal harm does not magically go away just because the mechanism by which the currency supply expands is legal. It persists the exact same way. And so the relationship between fiat money, currency debasement, and inflation that you would predictably expect to see is exacerbated wealth inequality, which is exactly what we've seen to a pronounced degree since we went off the gold standard 54 years ago. My favorite example of this is probably what happened in the stock market in 2020. Again, recall that theoretically, the value of any investment, including stocks, is the net present value of all its future cash flows. In 2020, for the first time in human history, we artificially shut down the economy. Now, analysts' expectations for corporate earnings was low. They expected corporations to earn less money. And of course, that's exactly what happened. Corporate earnings were far lower over the next year or two than they were projected to be before the pandemic hit. So if that's the case, why did stocks get 15% more expensive that year? Something to think about. Hidden taxation. When any government wants to spend money, largely it has three options to do that. It can tax that money away from its citizens, it can borrow that money from its citizens, or it can print the money out of thin air at no cost. And as it turns out, one of those things is a lot easier to do than the other two, especially if the amount of money the government wants to spend is very large, and especially if the thing they want to spend it on is not very popular with their population. The example that I use here, it's probably hard to read, but this is from the newspaper, the Financial Times. It's a British newspaper from November 23rd, 1914. And this harkens back to a scandal that was only recently discovered where, in the lead up to World War I, Britain was trying to raise money to fight the war through the sale of a war bond. But the bond was undersubscribed. Only about a third of it was purchased by actual investors. So surreptitiously, secretly, the Bank of England, through private agents, printed pounds to buy the other 2/3 and then sold it to the public as if the bond issue were massively successful, when in fact it was not. They printed the money out of thin air. And I call that hidden taxation because even though it's less direct, it's not as identifiable as the government taxing a dollar out of their pocket. Via the Cantillon effect, expansion of the currency supply, always in all forms, benefits a small number of economic participants at the expense of everybody else. It is functionally the same thing as taxation, whereby the government funds its operations by diluting the wealth of its citizenry. I don't want to play revisionist history, but this also, I think, relates back to the problem of malinvestment, where if the population doesn't want a particular government to spend a bunch of money on something, maybe that's because it's not a very good idea. And in this case, there's a lot that's been written about fiat currency and expansionist monetary policy facilitating war fighting. And in this case, it's pretty obvious that Britain's ability to fight World War I would have been significantly impaired had they stuck to an honest way of raising money rather than secretly printed the majority of the funds that they needed at the onset of the war. And, as far as revisionist history goes, you can imagine how many fewer people would have died in that war. You could even imagine, I would say, a mitigation of some of the things that happened after that, in which case a lot more people died. But the fundamental problem is that, unlike taxation, which I would characterize as an honest way of funding the government, inflation is a way to fund it without that honesty about what you're doing. And among Austrian economists, libertarians, cypherpunks, freedom fighters, there is a core idea that it is a profound injustice for a government to force its citizens to exchange their time, labor, blood, sweat, and tears for a currency that it has enabled a privileged private banking cartel to print costlessly out of thin air. But for decades, no one could figure out how to solve that problem. The technology didn't exist. And in a 1984 interview, Austrian economist Friedrich Hayek said, "I don't believe we shall ever have a good money again before we take the thing out of the hands of government. That is, we can't take it violently out of the hands of government. All we can do is by some sly, roundabout way, introduce something that they can't stop." And then, in 2009, in the depths of the great financial crisis, 95 years after this Financial Times headline, there was published online a new digital monetary protocol called Bitcoin. And embedded in the very first Bitcoin transaction was a message that referred to a headline that same day, January 3rd, from this same British newspaper, the Financial Times. That message in Bitcoin's Genesis blog reads, "The Times, January 3rd, 2009, Chancellor on brink of second bailout for banks." And of course, those bailouts were funded via printed money, expansion of the currency supply. So Satoshi Nakamoto, whoever he, she, or they are or were, we may never know. I don't think we ever will, but they gave us a pretty good indication about why Bitcoin was created and the fundamental problem it was created to solve.